Most people think an emergency fund is just 3 and 6 months of expenses, but that's often a dangerous oversimplification. This video will show you the exact amount you truly need, tailored to your life. You'll learn where to keep this money so it's accessible but not easily rated, ensuring it actually grows, even if just a little. We're talking real protection, not just a mental placeholder. But first, a critical rule. An emergency fund is for genuine emergencies only. That new TV? Not an emergency. Unexpected car repair? Absolutely. This fund is your financial shield, not a spending slush fund. Forget blanket advice. Your ideal emergency fund size depends on three key factors: your job security, your dependents, and your health. Each factor shifts the goalposts significantly. If you're in a highly stable job with low risk of layoff, single, and healthy, your baseline might be lower. Think of a tenured professor or a government employee. However, if you're a freelancer, have a family relying on you, or manage a chronic health condition, you need a much larger buffer. A single unexpected medical bill can wipe out smaller funds. For example, a self-employed graphic designer with 2 young kids and no health insurance needs at least 9 to 12 months of expenses. Their income is variable, and their family's needs are high. Don't guess. Be honest with yourself. Calculate your true monthly expenses, not just your bills, but everything. Groceries, gas, subscriptions. Multiply that by your honest risk assessment. 3, 6, 9, or 12 months. This is your personal target. Many say your emergency fund must be instantly liquid, but that's not entirely true. It needs to be accessible quickly, yes, but instantly implies leaving money on the table in a zero-interest checking account. The sweet spot is a high-yield savings account, HISA. These accounts offer significantly better interest rates than traditional banks, meaning your money actually works for you, even in an emergency. Most HISAs allow transfers within 1 to 3 business days. Is that instant? No. Is it fast enough for 99% of emergencies? Absolutely. A broken water heater can wait 2 days for funds. A job loss requires planning, not instant cash. Think about it. How many emergencies truly demand cash in hand, this second, that can't be covered by a credit card for a day or two, which you then pay off from your HISA? Very few. Compare a 0.01% interest checking account to a 4.5% HISA. Over a year on a $10,000 fund, that's the difference between $1 and $450. Which would you rather have? The choice is clear. Look for HISAs with no monthly fees, no minimum balance requirements, or very low ones, and FDIC insurance. Online-only banks often offer the best rates and easiest setup. The biggest threat to your emergency fund isn't inflation, it's you. Access needs to be just difficult enough to stop impulsive raids, but easy enough for genuine crises. The key is strategic friction. Don't link your emergency fund HISA directly to your primary checking account. Use a secondary, less frequently used checking account as an intermediary for transfers. This adds a tiny layer of friction. Instead of one-click access, you have a 2-step transfer. That extra minute or two might be just enough to make you reconsider a non-emergency withdrawal. Imagine you're eyeing a fancy new gadget. You go to transfer funds, and that 2-step process makes you pause. Is this really an emergency? Often the answer is no, and your fund stays safe. Consider opening your HISA at a completely different financial institution than your main bank. This physical and digital separation creates an even stronger psychological barrier. Another trick: automate contributions to your emergency fund. Even small regular transfers make it grow without you thinking about it, reinforcing its purpose as a separate, untouchable pot. The core principle here is intentionality. Your emergency fund isn't about avoiding budgeting. It's about building a specific, robust safety net for life's inevitable curveballs. It's about having a system that works, not just a vague goal. By understanding your true needs, optimizing where you keep the money, and adding smart friction, you create real financial peace of mind. Next week, we're busting another common money myth: the idea that you need to be a stock market wizard to invest. We'll break down simple, effective investing for beginners. You don't want to miss it. Hit that subscribe button now to join the Plain Money community. We're here to make finance make sense, so you can build real wealth without the stress or the jargon. See you next week.